Start over. Yes. It was the year 2001. Not just kidding. All right. So, the thing I that really helps me set my bias and my understanding of the really important levels and the sort of macro moves of what's happening in a particular market is market structure, right? So as you guys all know, stocks can go up, down, and sideways, right? Use a blank piece of paper here, right? And the market is a never ending. This isn't the girl from Wendy's. This is, your phases of accumulation and distribution, right? This pattern of accumulation, markup, distribution, markdown repeats infinitely in all markets, fractally in all time frames, right? We go from compressed states to wide states to compressed states where you have distribution, back to wide states, etc., right? This is true whether you're trading a bull flag or a falling wedge to a weekly or a monthly breakout, right? It's true whether you're talking about finding the bottom in BBBY yesterday or taking a massive monthly breakout in Meta. These concepts are fractal and they're universal and they apply to price in all trading instruments, in my opinion, because they reflect trading psychology, right? So one of the things Richard Wyckoff was obsessed with, right, is understanding how big institutions uh, get in and out of positions, right? And uh, as traders, by the time we see transparency in the market, right, it's usually too late. You've already missed the trade. Our job as day traders, would you agree, Type 11, if you agree with this, that our job as day traders is to skate to where the puck is, not where it was, right? We have to extrapolate the move, visualize the move, and hopefully enter the trade before the move happens so we're not buying into a better trader's sale, right? It's the ultimate game of musical chairs. Make sense? So, uh, Wyckoff understood that for periods of distribution and accumulation, the most important thing was to be able to track the footprints of that distribution and accumulation. So if you're, for example, JP Morgan or Goldman Sachs, do you want the rest of the market to know that you're accumulating meta heavily at 158? Or do you think you want everyone to be clueless until filings are out? Which which scenario do you think is more likely? Clueless, right? You want to gobble all of that liquidity, right? All of that liquidity without the market noticing into phase one, right? By the time you hit the top of phase one, what do we call this? What's that called? A markup. That's right, Kelly. Not Kelly's first rodeo, I guarantee you. Yes, it's called the markup, meaning it's like a markup, right? You're buying wholesale here and you're paying up dearly. Why would you be paying up dearly, by the way? Why would you be paying up dearly? FOMO? Yes, you'd be paying up dearly because the market has now broken phase one and experiencing a massive demand imbalance, right? There's much more demand than there is supply, and price shoots up at an accelerated rate. If you're Hot Rod Johnny at JP Morgan and a stock has reached the end of its cycle, do you want the rest of the market participants to know that you are offloading, I don't know, 10 million shares of Apple? You're a bank. You have a large client, pension, another institution, a fund that says, listen, we need to offload Apple. You just sell 15 million shares in the next couple of weeks. Do you want the rest of the market to get a whiff of that? How do you go unnoticed is what we're going to talk about, right? How do you go unnoticed? Accumulation and distribution structures are the foundations that undergird how I look at levels in general. And then there's everything else. So that's what we're going to talk about today. So here's a very simple schematic. Every trader over the age of 40 has probably, or 50 has probably seen this schematic over and over in their trading education, right? There are 4 phases and then a markup phase. So phases A through E within a distribution, right? And this distribution, accumulation allows you to mark ranges carefully, mark levels carefully, and understand the order flow in its phases so you can draw clear maps of levels that matter prior to the breakout. Okay? Let's look at Netflix together. Take all the lines out. Okay? Take all the lines out. I'm going to ask some questions. We got 3 legs down in Netflix, right? 1, 2, this is your 3rd leg down. What does that volume tell you on the 3rd leg there in late April in Netflix? What's unique about this volume? Yes, it is exhaustion volume. It is the volume that typically marks the end of a move, right? Okay. So typically, as we mark the end of this move, what is this? What do we typically refer to this formation as? Yes, it's a rounding bottom what? It's a rounding bottom base, right? Correct. Saucer bottom. So in the beginning, we have here a selling climax, right? A 2-legged selling climax. What happens after the selling climax with price? It is a cute Machine Gun Kelly keeping it classy. Yes, you get your automatic climax, and then you get your what? Pop quiz. Yes, your secondary test. Very good. At the point where you get your secondary test, is it fair to say that you can start drawing some lines? Yes, correct. Okay, beautiful. Is it fair to say that I can then start extrapolating a range here and say, okay, here's the base of our range, right? Each of these phases is characterized by certain types of order flow, right? Phase A is your selling climax. Phase B characterized by your retest. Phase C characterized by a lower test to ensure that your primary pivot holds, right? Phase D is marked by your sign of strength out of the base, and phase E is characterized by your sign of strength and your retest or LPS, right? And then what happens into phase E? The markup, exactly. So one of the primary approaches I use on hourly, weekly, daily basis is is to draw the schematic of the base in order to understand primarily what the range values are of the base, and secondarily, right, where my retests and signs of strength are. How often, guys, do we have a reaccumulation base, right, where we break high of day, right? We retest your LPS here, you retest your pivot, and I say to you guys, let's see what price discovery does here. Let's see if we get a shakeout hammer. Let's see if the 21 is catching up to that shakeout hammer, and let's see how we take the pivot back to confirm a second move on the leg. How often do we have that conversation in the room? You guys are probably so sick of me hearing me say that, right? Like almost every day. These concepts are valid intraday as much as they are valid on a weekly, daily, hourly, or monthly time frame, because these are the mechanisms of how the market, in its endless auction, discovers and accepts price, right? And so we'll dive deep. We'll dive deeper here. So now let's break this base on the hourly, right? So here's the levels we're talking about, right? Okay. Selling climax, your spring, your automatic rally, right? Now, we're pattern traders, right? So as pattern traders, when we're drawing these patterns, what are we constantly calling out? Talk to me. We're calling out pivots, right? We're calling out wedges. We're calling out bull flags. Our We're calling out support and resistance. Correct. So the top-down approach, right? First comes market structure. It's the most important thing. Intraday, am I worried about an LPS on the weekly in Netflix? No, but my levels are marked down, right? If I just exit here and show my lines, it looks like somebody spilled spaghetti on my charts, right? Uh, However, this general market structure informs my bias primarily from the top down lower. Okay, So we have market structure. Then we have patterns, right? Okay. If I have a pivot here through a neckline, right? And I see a left shoulder, right shoulder cheat area. Is this based on my trading style, right? Is this going to be a level I'm extremely interested in entering on a daily or hourly level? Just based on how you guys have seen me trade. Extremely, right? Okay. The pattern is a confirmation of what? Once you have your market structure and you have your basic pivots, what does the pattern confirm? The pattern confirm yes, but the demand zone, true, and it confirms what else? It confirms the order flow. Exactly, Ari. Correct. All of these things are part of one general picture, right? We buy compression into expansion, compression into expansion, compression into expansion. Why do we like to buy compression into expansion? What do you get the most of and the least of? Risk reward. Exactly. Money, money, cash, cash. But the way we do that, right, is by getting the most, the by far the best risk reward, right, and the least amount of space to move between supply and demand zones, right? If I have an inverse head and shoulders, that's the worst inverse head and shoulders ever. Wait, I forgot how to draw an inverse head and shoulders. What is wrong with me? Uncle JR is going to start sleeping more. All right. So if we have an inverse head and shoulders pattern here, right? And say the neckline is, I don't know, $52, right? But we've been in a falling wedge right side down to $46, and toward the end of the day, we are in a buying climax into $52. Is that a supply zone that's likely going to be broken with volume, with enough demand fuel to give me the measured move, the coveted measured move that we're looking for? Why not? Okay, it's end of day. It's already moved, right? And what's been exhausted already? Buyers, your order flow is done for the day. Everybody who wanted to buy this particular instrument fulfilled their orders on the day, right? Now, I'm getting my, hold on a second here. Where's the eraser? All right. So now scenario two. You have the same inverse head and shoulders pattern, right? And you open right here in the pre-market. You're super tight. There are no sellers beneath 51.75, and you have high pre-market volume. What is the likelihood that your gun is fully loaded, right? Your what's the better analogy? Your fire extinguisher, your flamethrower is full of gas. What is the likelihood that you're going to be able to fulfill that measured move off this right shoulder? It's good, right? Your buyers and sellers are stuck in a very tight supply and demand zone at the top of a buy point, right? So what we look for are tight consolidations within bullish or bearish patterns that from a top down confirm to the market structure points where we're most likely to see signs of strength, sign of strength, sign of strength, etc. You have to be keenly aware of where you are in the market cycle, within this market cycle, in order to trade these patterns effectively. It's not good enough to just have compression in a bullish pattern. You have to look at the overall market structure that you're in order to ensure that you have the room necessary for the move that you're looking for to complete. One of the biggest problems that I've seen, working with other traders in my career is like a deep misunderstanding of how patterns work because they're missing the bigger picture. They're not understanding the market structure and the order flow, and they're trading the pattern in isolation without context. How many times does that happen to you guys? You see a bull flag and you forget that you're into a major area of overhead resistance with buyers in your face, ready to sell to you. Remember CLF yesterday? We caught this move in real time. I'm not saying this to toot my horn, not saying this because we have an open house. I generally hate sounding like I'm bragging, but the point of this chart is to showcase what it is that I'm talking about. I am terrible at drawing tools. So we traded a lot of news flow in this room, but we're technical traders, right? So yesterday we got the CLF news. Your average retail trader is not looking at long-term charts. What is this right here? Let's go from the left side to the right side. Yeah, it's a descending triangle, right? So this was your first leg down, descending triangle, second leg down. This is a micro accumulation zone, right? Your selling climax, your automatic rally, your up thrust, your higher base here. And then on the following day, what happened with CLF? Was this a technical breakout or was it headline based? It was news based, right? Look at the volume that came in. It's a beautiful thing. We took this trade in real time. We caught it early. You had a bar by bar trade through here, right? I know we didn't catch it that early. We caught it through here. I'm sorry. Uh, but what were novice traders doing? They were scared to enter here. They were greedy here, and they were terrified they were going to miss the move here. You guys remember that? We're professionals. What do professionals do? Everybody say it together. 4 words. Look to the left. Yes, I can retire a happy man. Kelly, you take over this job. My mission is done. Mic drop. That's right. You look to the freaking left. What is this? Other than obviously it's a descending triangle and a breakdown and 3 legs down. But what do you have here? Supply. You have losers. You have sellers, right? Now, some overhead supply is good overhead supply, right? If you're in a base like AstraZeneca, which we talked about yesterday, the people stuck in that overhead supply want to be there. They're positioned for a reaccumulation breakout and a markup. These people have found religion. They want to get out at all costs, right? So if you look at a 15-minute chart, within one glance, you should see, okay, 3 legs down off a gap down, accumulation, breakout off the base, a markup. We get news flow here. It should be instantly clear that your target is 1830, right? So these concepts are equally applicable whether you're a core and a swing trader like Mark Minervini or like Stan Weinstein, or if you're a deranged maniac like Aiku, who is a very good trader in his own right, or any other trader in this room. It spans the gamut, right? These concepts span all time frames, and they span um, all instruments, all trading instruments. It doesn't matter whether you're trading forex or equities or futures or ticky tacky sticks. The same principle applies, right? He is our deranged maniac. I love IQ. Every room needs one of them. He's the best. All right. So going back to what we were talking about in Netflix, right? Go back to the hourly, my favorite chart. You have your rounding bottom. You identify market structure. You identify key levels with pivots. And then you start to identify order flows and patterns. You guys know how I trade. Do the formation of patterns for me identify actual levels? Yes or no? Yes, absolutely. Remember when the cues were forming an ascending triangle? Here, the pattern gave you the level, right? Did a coincidence that after this initial sign of strength, that your pullback was right to the top of the ascending triangle? You think that's a coincidence, or do you think they retraced right back to a demand zone? There are no coincidences in the market. Exactly. Every tick matters, right? So again, market structure, order flow, tape reading, patterns. Excuse me, had an itch. They all inform us of the levels that are relevant within the particular structure we're trading. And that is how I derive my levels. Now, my charts are not pretty, right? But the levels I draw help inform me of the pockets of liquidity, of the structure that we're in, and the pattern. What were we saying last week? Last week we were saying, okay, we have a left shoulder, We have a right. We have a head. Let's rally. Let's rally into this trend line, this descending tops line, so we get a right shoulder. Right, right there. Here's our pattern completing. This puts me in a particularly bearish state of mind. I don't know what Jerome Powell is going to say tomorrow, but this chart makes me think that a lot of people may be thinking that we get a little bit of a hawkish surprise tomorrow, right? So it is a combination of all things that informs my bias and informs my trading decisions. The levels are constantly changing, constantly. Depending on your trading style, they constantly change more or less. So, if you're, I don't know, if you trade on the weekly time frame, like Mike Webster or Stan Weinstein or one of those guys or Bill O'Neill, you're going to be looking at daily and weekly levels, right? We're intraday traders, so 15-minute pivots and hourly pivots are really important. Remember this morning I said, guys, watch the break of $317. What happened this morning? Get a micro wedge, break of 317, bull flag, secondary leg, right? Right near the trend line. And then where do we get our bounce? 317. This level is informed by the 15-minute chart. I don't need to look at a weekly chart to understand that $317 is critical, right? Make sense? Does it matter that this 317 was violated here? No. Does it confirm the level that 317 was violated and then we got a super bullish turnaround reversal bar that took the Qs 90 cents higher? What is that telling us, guys? Yeah, hammer time. What is right? What is this right here? What are we in right now? It's a range, but my brain is saying selling climax, automatic rally, spring, sign of strength, retest, sign of strength, retest, and now we have the range confirmed, right? This accumulation theory works on the 2-minute like it works on the weekly or the monthly. It is a way of viewing the market, of viewing accumulation and distribution structures that then I combine with pivot levels a la Al Brooks, who is a master of price action, and I deploy to fit my particular trading style because I am a scalper and a day trader primarily. And we're in lots of swing trades too, but our bread and butter in this room is made by catching 80-cent moves, $2 moves, $3 moves, right? I'm not looking to catch 20% in NVIDIA, right? Yeah, it's an accumulation structure. Exactly. Does that make sense? And while we're getting the shakeout hammer, right? What comes in to my analysis? What am I constantly talking about as we're violating key levels? What are we looking at? Yes, it's called a distribution top, right, John? Price action and tape, correct. As 317 is violated, is it a quick plunge and then a very strong bounce where liquidity is being taken out at the offer at 2 or 3 times the rate as the way down within that 2 minute bar? It was there, right? So what does that tell us? You're more likely dealing with a spring than a breakdown. Now, are these particular things useful to a swing trader? Not really, right? You have to adapt your tools to what it is you're doing for yourself as a trader, right? Make sense? So there goes 317. Yeah, we'll see. We'll probably get a nice bounce off the 200. Yep. So that's my particular approach to drawing lines. Top line approach, market structure, pivots, then price action, order flow, and patterns. And they all work together. And that is how I approach drawing lines. First, understand the range of the general larger move, the general larger base. Are you in an accumulation or distribution structure? Are you in a markup or markdown? First question you should ask yourself, right? Al Brooks would call that understanding your market direction. Are you in an uptrend, a downtrend, or a consolidation? Market can only do three things. They photobomb me? I don't know if they photobomb me. They're testing levels. It's okay. If 317 breaks up to the upside, then I was right. I was wrong. Who cares? This is this is more of a overall conversation of how I approach the market, right? So see, there goes 317. In your face, Rob. See. Anyways, so um, that is how I approach drawing lines. You guys see me do this every day, especially intraday and at 7 o'clock. And I take all of those elements together and approach those things holistically. Now, as traders, you're each going to have to find a way to find levels that work for you based on your style of trading. You know, I'm sure Kelly draws his levels differently. Kelly, for example, uses a lot of fibs, which are a phenomenal tool as well. And other traders use different things. Some people use time extensions. A lot of people like pitchforks, which are a combination of fibs and um, and trend lines. It's really a matter of finding a way to read the guideposts of the market that conform to your style of trading. Coin flip, haiku on the 50-50 method of trading. 315.60. I don't know. I'd have to look. But clearly, it's been a level that's really paid dividends for us. You know, been a very solid level to work with. Um, it works, yeah, 50% of the time, 100% of the time. Um, the market is constantly testing, right, Beans? What is this, guys? What is this bar? It's a shakeout bar. Exactly, Dan the man. The market's testing that level. What happened to the shorts there? They got bear trapped a little bit, right? Yeah, exactly. It's, it's almost 1 o'clock in the afternoon. Anything could happen. It's a little beside the point. And we do bar by bar analysis in the room all day long. Uh, the point of that particular example is really to try to convey what I'm doing every day, come up with levels, and combine the market structure with patterns. Let's go back to Netflix and let's put the drawings back on. So this is a big declining tops line, right? Do you guys remember this day in July? This massive breakout here? What were we seeing? Lower pivot lows, ascending wedge reversal, failed to make new lows, and daily double bottom. The shorts couldn't keep Netflix below 170.34. And what happened here? New igniting sequence. Yeah, exactly. So for me, it's a holistic approach. Yes, market structure is important, but the patterns that begin to form within that base, within that structure, right, and the order flow is what we're trading. And that is top down my approach. Boom. Does that make sense? I always feel like I'm a little esoteric when I talk about these things. So last night we were talking about, a lot of you guys missed it. Uh, let's talk about a reaccumulation base. AstraZeneca, right? What pattern is this on the daily? Bring up the daily. Yeah, it's a beautiful inverse head and shoulders, right? And what is this right here to the side? What's happening? Yes, it's an accumulation base, right? Accumulation doesn't just happen at the bottom, right? You have areas of reaccumulation. This is what a bull flag is, right? Rally, base, rally. What's happened here is you built the left shoulder pivot, 69.64. Here's your head. You put in a right shoulder pivot low, and what's happened since? Have the bears been able to retest lower lows? Have they been able to retest lower lows? No. So the people in this base, right? The people in this base right here, are they the same people that are buying CLF at 1829 and 1830 and 1831? Was that a reaccumulation or an exhaustion? Right. The people, especially, I mean, this is an institutional name, right? The people who are buying AstraZeneca here, are they afraid of 67.64, or are they looking to buy more through the breakout? Right. But they're both in this industry blindly called resistance levels, right? Are they the same kind of resistance levels, or are they completely wildly different patterns and structures? Wildly different, right? This is a move where most people who are in here are happy to be here and are looking to add more when it breaks this level. This happens on every time frame. When Kelly catches a move off of compression and it takes the first test of the 21, how often do you guys see him add to the trade? Often, right? Because he understands that he's buying a reaccumulation structure or reaccumulation pattern that's likely to go higher. Just because the trade is pulling back intraday doesn't mean it's broken, right? Make sense? Everyone on this right shoulder, not everyone, I can't make the wild generalization, right? But typically speaking, when you put in this type of pattern and this type of name, the people who are in here generally want to be here. So if the people who are in this right shoulder pattern want to be here, what are you waiting for at 67.64? Right. You're waiting for the markup, right? For the next leg in the trade. Not all resistance is created equally. This reaccumulation structure may be at an overhead supply zone, and yes, technically 67.64 is resistance, but does it look anything like this did up here? No, exactly. So that is why the top-down approach is so important. And phase energy right here. Take a look at this daily. This is a trickier one, right? 257.55. You had uh, some buyers through here, right? We had an A plus trigger at 220.80, 220.99, right? Uh, and you have some people who bought through this. Market leader, okay? So you put in a V bottom and a platform. A platform is what? Same type of accumulation structure, right? Do you think the people, mostly institutions who are buying this is a market leader with resounding fundamentals. Do you think they were worried about the 15 or 20 trading sessions where you had some buyers up through here? Not even a little bit. You had earnings right here, breakaway gap, right? Markup, and your first pullback to the 21. We took this trade yesterday. Do you guys remember this trade? What was this? You don't remember this? We were all over M-Phase. First test of the 21, inside bar, and we took it over 287, right? This was your markup, consolidation, test of the 21, and we took it right here through 294.24. Got like a $6 or $7 move. 7-year auction coming out. Yeah, the Qs are, they're holding 317. There we go. So I'm putting together like a course on price action patterns and market structure together. It's real slow. Um, so we'll get much more into detail, but that's kind of the nutshell of how I approach drawing levels and looking at levels in supply and demand zones within context. Not every line that people call resistance is necessarily a line I'm scared of, right? Some lines you really want to buy through, some lines you want to sell into, and that's the crux of it. GR do one real time today, dude. I do that like 6 hours a day, Richard. We'll draw Tesla today if you guys want. That's I've been blabbing for a while, almost an hour. Any questions or anything you guys want to discuss? We will have a like a more of a formal course on this in the next few months, hopefully before the next open house. But I get asked almost every day what my approach to drawing levels is, so I figured I'd give you guys a preview. All right. Qualcomm in light of levels, or okay. So what do you? I mean, you look at Qualcomm, right? A couple of things should instantly draw your attention. You could draw this trend line like this, or through this top and call this a falling wedge. Here's your selling climax, your automatic rally, your higher pivot low, your uh, sign of strength, accumulation base, breakout, inside bar, breakout into the 200, and now here's your distribution top. Make sense? When placing options, how much time do you need? Are you talking about time decay? It depends. It depends on your. It depends on the expected move, and it depends on the time frame, and it depends on your time frame as a trader, right? A lot of guys in this room will do like short-term swings in the Qs and SPY. Like I'm short both through puts right now because I'm expecting the market to drop after Friday. But you know, I'm usually like 4 weeks out, but it really depends. What's not a bull flag? Qualcomm? Uh, I don't see it as a bull flag. Remember, multiple patterns form uh, together often, right? What do I always say about a head and shoulders? What is a head and shoulders until proven otherwise? It's also a falling wedge, right? There is a competition of patterns because there's a competition of what? The competing patterns reflect what, guys? Yeah, exactly. There's people betting on the bounce off the falling wedge off the neckline, and there's people short here and short here betting on the measured move down. The patterns actually reflect the order flow, right? That's the whole crux of this conversation. What Kelly said is critical. Time on the chair. You have to take those losses. You have to put in the time. Just draw Wendy's wig, right? Phase 4. Trader tuition. Exactly. So, yeah, markdown. Susan, she's like, I've paid my tuition already. Leave me alone. There are no shortcuts. Let me tell you, there are no shortcuts. You have to develop a trading style that is your own. You have to take knowledge from people that impart knowledge onto you that makes sense. And then you have to figure out what works for you and develop your own trading style. You are not going to become a successful trader by imitating other people. That I can almost guarantee. I took the things from Al Brooks and Tom DeMark that I liked, and then there are other things that I think they use that are preposterous. They don't work for me. So guess what I'm going to do? I'm going to not use them because I'm here to win and make money, right? So if a tool or an approach or a strategy doesn't work for you, does it really matter that it works for Gator or Kelly or Eddie or Rose? No. It's a very lonely business. Mike, it depends on how much capital you have. If you're over PDT, for me, I can't make a trading or investment recommendation, but I have found that people who are over PDT and trade very small amounts of real money uh, tend to do better because you're dealing with the psychological pressures of losing, even if you're trading one share. That being said, you should paper trade until your execution skills are up to par, right? So if it takes you 60 seconds to put in a buy stop order and then you're not looking in the right place. So a huge part of being a successful day trader is just looking in the right places, right? And having your OODA loop work correctly. So if this is your level two, your order box, right? And here's your prints, here's your market depth, right? And here's your like order status and position status. Believe it or not, when you're stressed out and you're entering trades, the amount of information you have to process, looking at order flow, looking at tape, and seeing where you are in the trade in terms of your average entries and your pending orders while looking at the levels is a lot. Like how many of you guys, when you first started day trading, you had a tremendous challenge in being aware of all this information while watching price? Huge challenge, right? So paper trading is really good to train your mind to execute correctly, hit the right buttons, hit the right hotkeys, and develop that OODA loop. Uh, Observe, orient, decide, and act. Um, to learning that OODA loop and really cementing that skill set, because when you start trading real money, what stress does is it gives you tunnel vision, and it makes making decisions much harder, right? So familiarity with your platform, familiarity with execution, and developing a really strong OODA loop to properly focus on what you need to focus in real time as a day trader is really, really important. Also, yeah, muscle memory of the eyes. Yeah, so everything I've said for 20 minutes, Kelly just said in 6 words. Kelly makes me look so bad in this room. Yeah, train your eyes. Um, but also, like, you have to build that psychological muscle. So as a stock is pulling back against you, you have to decide, okay, here's where I entered. If I had a proper entry, is this pullback part of the trade? Is this pullback? Uh, does this pullback indicate that the trade is working, or does it indicate that the trade is broken? Right? You have to be able to decide all that while managing your execution. The other thing I'll say is, uh, as a beginner, you really should be looking to trade easier instruments. Like if you're three months out of the academy, so to speak, maybe you shouldn't be trading Tesla just yet. Maybe you should be working on like Wells Fargo or I don't know, some slower, more controllable name so that you can get your chops up before you're, trading against the best traders in the world. Apple, yeah. I mean, it, not come on, Pete. Nobody deserves to trade Ford. Stop that. You're gonna scare the open house attendees away. Um, so yeah, so the I think learning on demo mode uh, is important at first, but if you have PDT, for me, I think it's a lot better to tier down, take a $5 risk, $10 risk, $1 risk on in your tier size, and trade with real money because you're gonna get real fills. You're gonna start to experience to learn to manage to experience the stress of loss because you have to remain rational and learn to follow a plan, right? While a trade is going against you. And that is probably one of the hardest things for a day trader to learn, right? Because when you're starting out, you lack a tremendous amount of confidence. Sometimes you win in a trade that you shouldn't have won in, and that builds your confidence. And sometimes you lose in a trade that was the right trade to be in. And learning to tell the difference takes a very, very long time. So while proving all of that to yourself, you have to learn to manage your emotions to the point where you can make intelligent decisions to discern that while you're in that trade. Are you going to be able to do that if you're in 5 contracts at Tesla? I don't think so. I think that's one of the biggest challenges. I call that phenomenon Plato's cave. You're kind of in the dark and you're not sure if you're doing the right things for the right reasons or the wrong things and winning anyways. Like a lot of people that I've spoken to made six, some 7 figures in 2020 because they had the biggest quantitative tailwind in the history of tailwinds, and everything was going up and trading was easy, right? And this year, things got real. Trading got much more difficult, and a lot of people had to reassess whether they were doing the right things for the right reasons. A lot of people had to relearn how to day trade this year. We had 12 years of quantitative easing. So that's been, I think, illuminating for a lot of people. Ask Kathy. Yes. Can you imagine if you're like walking by online day trading academy and you see Kathy Woods coming out in a baseball cap and sunglasses? Anyways, um, yeah. So we'll definitely get more into it. We do a lot of this type of analysis and discussion about psychology every night and intraday. But we'll be putting out a course on market structure and price action hopefully before the next open house. So that will be that's something that we're already working on. It's just it's a lot to cover. Anything else? Any other questions, comments, complaints, criticisms? How do you trade getting in that the close bar as buying or selling closes? Uh, I look at time and sales and the tape. I look at the offers and I look at the where the close. So at like 57 seconds on the bar, I'm seeing, okay, is this bar closing with a high degree of momentum, right? You have an igniting bar. Is the bar closing at 57 seconds, 58 seconds, 59 seconds? Are offers lifting into the close with a high degree of momentum? Are you closing near the top of that bar or are you putting in a 15-cent topping tail, right? If you're closing at the highs of that bar with a high degree of momentum and volume is rising, I'm just looking at the next period bar and take that up a penny or two for an opening range breakout, or as Kelly affectionately calls it, diving into the violence. The location of the bar is hugely important, Mike. Hugely important. So okay, so you have to look at signals within their context, right? It doesn't take a Wyckoff analyst to understand that yesterday when you took out the opening wick here, that you had a climactic selling climax into the intraday pivot, right? So intraday, you need to take some of these concepts. Look, second leg, selling climax, pre-market pivot, no brainer long, right? Two legs up, right into overhead supply. So you don't have to draw a five-phase schematic to understand selling climax automatic rally into a pivot. Make sense? Was the 2 minute reversal the last course you did? Yeah, Rose. Did you get a chance to watch that one? Did you like it? I don't know if you took it. Oh, nice. Yeah. Awesome. I'm really glad you liked it. Good times. Thanks for the lesson, JR. Feel fortunate to learn how to trade in this challenging market environment. Yeah, well, the nice thing about this room is everybody learns something new almost every day. I learn a ton from you guys. Everyone has a different approach to the market. Every trader here has a different focus and a different way of seeing the market, and the perspective shared are much appreciated. Can you tell me why it's not a flag? Well, you're really worried about that Qualcomm flag. Uh, so you had an upthrust through the 200, then a retest of the 21, and it's just messy and it's wide. Could you call this a bull flag type pattern? I guess. Would I want to take this flag breakout through the 156.89 level and the 200-day moving average? No. So I'm not even looking at this as a viable bull flag anyways, right? This has to base for a long time, retest lower lows, put in a right side near the 200, absorb all the sellers, and then give us a sign of strength and a retest. That's what I'm interested in trading here. This is not a pattern I'm remotely interested in trading. Like, how many of you guys are successful taking bull flag breakouts in the 200 on the 2 or the 5 minute or the daily? Like, how often does that work for you? Let me know. Yeah, so exactly. So why would I be interested in trading this on the daily? So if that's not a viable pattern, then I'm looking for this to form a base, a reaccumulation base. I don't care if it's a platform, if it's an inverse head and shoulders, it doesn't matter. What I'm interested in is getting rid of the sellers up here who are going to slap this down so we have a functional base that's serviceable to take a trade higher. So whether this is a bull flag or not, I don't obsess over that. There's some technical analysts who will fret and say, well, technically that's not a bull wedge, it's a pennant. That's where you lose me. It doesn't matter. Are you in a rally-based rally reaccumulation structure where buyers are going to outbid sellers or not, if you're long? And conversely, if you're short, whether supply is going to overtake demand. That's what matters. Now, it's important to be technically accurate with your patterns, right? And to me, this doesn't look like a bull flag, but much more important is understanding uh, whether that particular pattern is in a serviceable point within the market structure that's going to allow it to do what it's supposed to do. And in this case, Qualcomm is not set up to do that. Make sense? Let's see. Let's see all you haters that made fun of me. See? Spring, spring, top of the base, day highs. In your face, Rob C. Just kidding, bro. Anyways, I'm just teasing, man. Yes. But see, to our point, right? Inverse head and shoulders, shakeout candle, neckline break through day highs. These patterns repeat infinitely, fractally across all time frames. Let's take a look at Tesla. It's pretty. Nice igniting bar there. All right, guys. Anything else? Yeah, I bet Kelly is. Yep, very nice volume. Very nice digestive volume here. Got a little falling wedge there. Retested the 200 ahead. Looks pretty. All right, fam. I'm going to stop the recording here and let's get back to work. Good talk.